Without further ado, welcome to Robert Crayfourd. Robert's the fund manager for the CQS Natural Resources Growth and Income Investment Trust. And Robert's going to talk us through how energy and mining can benefit investors in an increasingly uncertain geopolitical world. So, welcome, Robert.
Hi. Well, firstly, thank you for those of you that are here, because I appreciate there's a bit of a draw with AI being discussed in one of the other rooms, and that's obviously been one of the hottest spaces in the markets, but we will touch on our views around that as well. Slightly unwieldy title, slightly unwieldy name of the fund, but in short, it's a resources, so energy and mining focused fund. But I'm going to take a slightly different approach on this presentation from our normal approach. So normally we present about the fund. Actually, what we're going to talk about here is big themes that we're seeing, how we view that, and how we are positioning for that ourselves. And hopefully that will create some thoughts for yourselves in how you position as well. So. Quick intro. I'm co-manager on the fund with my colleague Keith Watson, who, I've got over 20 years of doing this, so 20 years on the buy side. I'm a geologist by education, but kind of a lot learned in sort of doing the job as well. Keith and I run 3 resources-focused investment trust being closed-ended. I assume everyone's kind of fairly aware of that. But that really allows us to focus on that small mid-cap portion of the market, which is where we really think we see value. So we kind of focus on those names around $300 million to around sort of $2 billion, and that's where we see a sweet spot, generally sitting below sort of wider ETF inclusion, and we think that's where we can kind of really add alpha. So the 3 trusts we run, so we've got CQS Natural Resources, we've got Golden Prospect, which is a precious metal mining trust, and we've got Geiger Counter, which is a uranium-focused trust as well. Quite a lot of overlap in the strategies across all 3, and we'll definitely touch on aspects across. And actually, we think all 3 are actually very well aligned, conveniently, or very well aligned in this current market. But I'll explain why we think so. They're very much actively managed, so very differentiated from the passive strategies you see, and that kind of infers around that market cap aspect as well. So I'll just sort of flick on there, some basic details, but probably a bit small font and a bit wordy. So in summary, so commodities and global geopolitics are very closely linked. We spend a lot of our time thinking about geopolitics, how that influences commodity flows, how that impacts decisions to be made. And we're going to touch on a few of the main key themes that we think are kind of driving markets today. So a quick one on the fund. I did say I wasn't going to overly focus on the fund specifics, but what we believe we can do for investors is, if people want resources exposure, we can use our expertise in allocating to asset classes at the right point in the cycle, rather than buying copper at the top or buying gold at the top per se. Although we actually we see more upside on that one, which I'll touch on. But it's that kind of flexibility. So over the long term, we aim to outperform the MSCI World Energy and MSCI World Metals and Mining. Because of that flexible mandate, we can really switch our allocations between. We did used to have a benchmark, but it was discontinued, which is hence why we've chosen to prefer this for giving guidance. Key themes we're going to touch on today. There's obviously a lot we could go through. US policy, obviously front and center to pretty much driving everything that's going on in global markets, global economics currently. Within that, government debt sustainability, which I think is probably the biggest topic out there. I don't think it gets nearly enough airtime, just because people generally feel awkward talking about it. I guess I'm kind of putting myself slightly exposed on that one, but I'm certainly going to try and tackle that. And energy security, and this is where AI feeds in. AI has really brought energy security front and center, and we'll talk through that in a bit more detail. And actually how resources really can give you exposure to these without having to pay 30, 40 times sales. You can actually buy companies at what are historically logical valuations. So I'll start with gold. So gold's obviously been very strong. We've seen, I think if I point to that top chart, that's showing central bank demand. over the last, what have we got, 10 years, 11 years. What you can see is a material jump up in central bank demand for gold post-22. And that was driven by the Russian invasion of Ukraine. And that basically led to the weaponization of the US dollar. And central banks then saw the US dollar being used as a weapon and ultimately led to buying more gold for their reserves and selling US treasuries. What we've seen in 25, now with the trade war and US really kind of weaponizing dollar and tariffs, we anticipate a further pickup or continued strength in central bank demand going forward. So gold's been strong, that's been the primary driver. Bar and coin has also been strong. That's been primarily driven by retail demand, given FX concerns. So, if you're sat in China, you're trying to protect your wealth, you're concerned about currency moves and government tax take, then it's a good, effective way. And we've seen that strong. Jewelry has been weaker, unsurprisingly. Higher prices do lead to a slowdown in demand, but that's happened. That's in the numbers. Gold's kind of been sat around that 350 range. We think what really kind of adds excitement going forward, and the next leg to it, as well as strong central bank demand, is that bottom chart, which is showing we've got gold price in green, and the blue line is showing physical gold ETF holdings. So I'll touch on it in a bit more detail, but we think there's a lot of reason for financial markets to start to gain more exposure towards gold to seek protection against, primarily, against the fallout of government debt and the implications that has to government policy. So government debt sustainability. So we think this is one of the biggest risks, and as mentioned there, we think it's one of the biggest drivers, potential drivers of gold going forward, but we think it's a real driver of policy currently. So debt increase, and this is taking US debt. We have similar charts for other countries as well, but the US is fairly standout in its current deficit that it's running. So the dark blue is showing the debt total, which has been fine in the low interest rate environment that we had through the 20s and into the COVID period. And then we saw rates increase. And that's what's really created a sort of slow issue that could be kind of kicked into being tomorrow's issue, into being an issue that's really kind of here and now. And what that means is we've seen, and just to be clear, this is showing total debt level times by the US 30-year yield, but it's showing an effective tripling in the interest burden that would require. That doesn't hit instantaneously because the debt maturities need to roll over. But just to put this in, these are big numbers. So just to put it in context, US debt at 37 trillion, currently running around a 2 trillion a year deficit. That's versus a total tax take of 4.5 trillion per year. So they're running a 2 trillion deficit versus a 4.5 trillion total tax take. Clearly, that's unsustainable. Current interest rate is about 1 trillion, and that's going to roll over in the next few years into this higher rate as the maturities roll down. So why is this important? Well, firstly, I think it's becoming more of a here and now issue. It's definitely driving current policy led by, Trump, Treasury Secretary Scott Bessent, Musk, all know that this is not a sustainable situation. That was why Musk joined in with Trump, ultimately then got kind of kicked out when he didn't agree with Trump's new spending bill, the big beautiful bill, which is going to add 3 trillion to debt. But this is what's leading policy. So it's driving tariffs. So Trump's view is that by getting other countries to effectively pay import tariffs into the US, he can get other countries to try and close that deficit. There's also the DOGE measures under Musk that was aimed at cost cutting to try and close that deficit. And then this big beautiful bill, which I think is slightly misguided in how it's being targeted by the US, is ultimately trying to achieve growth, because if you can grow, that debt level becomes more manageable. So, where does that leave us? Tariffs are effectively a palatable kind of VAT that you can put on the US consumer. So if you're buying products from abroad, they're imported to the US, tariffs are applied. Effectively, that's going to push up cost. That is inflationary. That has the double-edged impact of actually pushing up inflation, which makes it harder for them to bring down rates. Total estimates on that, if you put a 10% tariff on imports, would be around 170 billion that could bring into the deficit. Treasury Secretary Scott Bessent had targeted 300 billion. So these are all big numbers, and I sort of appreciate I might lose people slightly, but this is bringing Trump into really focus on currently talking around ousting the current Fed chair head, which is Jerome Powell, and he wants to get rates back down to 1%. And this isn't just an empty threat. We've seen in the last week or last couple of weeks that he's ousted the head of the BLS, so the Bureau for Labor Statistics. They put out the most important statistics in the US, or at least two of the most important, between their jobs numbers and their inflation numbers. And just today, we've seen that he's now appointed a loyalist. So basically, we've got to a point where US numbers, official data is going to become uncertain. People aren't really going to be able to rely on it in the same sense, and it's kind of making a bit of a mockery of the whole system. So we're in this point where we've got record debt levels, even more issuances, higher rates, inflationary pressures that are going to keep rates higher, and ultimately they need to issue more debt. At the same time, foreign central banks aren't buying treasuries to the same extent. China's a prime example. They're rapidly selling treasuries, buying more gold, because ultimately it's not a promissory note to the US, so you lose that degree of influence. Most treasury sales that have happened over, certainly over the last 5 or 6 years, have primarily gone to the US boomer, who are now around peak savings in the US and actually rolling over and will start to draw down on those savings. So it's hard to work out who they're incrementally going to sell these to, which ultimately leads us in a situation where rates have to stay high. Trump wants them lower because the interest burden is too high, but ultimately there will be pressure. Now, there's a high probability that he will be able to put pressure on the Fed and get rates lower. We're starting to see that come through, but it isn't going to fix the problem. And this is an issue that's going to remain. Ultimately, I think this leads us to a point where there's a real kind of reality check. There's going to have to be more dollars effectively printed, which is in itself inflationary, but more from currency devaluation than demand pull type inflation. And ultimately that'll drive the US dollar weaker, which as the central sort of reserve currency. So the dollar year to date is already down 9%. There is definitely scope for having kind of bear market rallies in that, but ultimately the pressure through more printing is likely to be lower. And then tariffs are now starting to feed through. So tariffs is because of how US corporates operate with their inventories. Those inventories come through, and it takes a degree of time for pricing pressure to kind of feed through. So we anticipate more pricing pressure to begin to feed through later this year. And we're starting to see jobs data now really starting to soften. So this paints a scenario which is effectively stagflation. And we have to go back to the 70s when we kind of materially saw a stagflationary period. And I'm not trying to claim that we're going to see double-digit inflation again, or job losses in the same sense. But really that, we believe, is increasingly creating a really positive backdrop towards gold. So we talked about central banks buying. Financial players generally hold gold through the physical gold ETF, and we see that all current gold ETF holdings total $300 billion, which sounds a big number, but that is less than 10% of the value of Nvidia or Microsoft. It's 0.1% of global assets. Historically, people may have held 5% or so in gold. So there's real scope here for a generalist kind of catch-up trade to owning more gold to seek protection against the potential fallout of this US or sort of global debt situation. So it's a difficult one to speak about because it's very difficult to call when that really kind of kicks in and when the market really starts to trade on it. But I think it's something people should be aware of. I believe it's going to be a driver of people incrementally layering in to owning gold for a degree of protection against what are very lofty valuations. We've got most global indices trading near record multiples on both kind of earnings multiples or NAV. So I just urge a degree of caution. So the other reason we like gold is we like the gold miners, so we invest in the gold miners themselves. We can see on the top chart there, you can see gold price in green, and we've applied gold mining indices in blue. And this is just taking the last 12 months, but the chart looks similar if you actually go earlier as well. And we've seen a 1-to-1 relation between the gold price and the miners. Normally you get around a 2-to-1 relation, so gold miners would outperform gold because you get effective operating leverage. So if you're producing gold, to put it simply, $1,000 per ounce and gold was $2,000, when it goes to $3,000, your margin doubles, although it's a 50% increase in gold. So that's the basic thinking behind it. And the net outcome of that is we can see to the bottom chart is that we have the sector overall trading at some of the lowest earnings multiples that we've seen in history. That's both on, I've taken forward PE there as a kind of easily understood metric, but it's similar if you look across price to NAV or different measures. So the sector overall, currently trading at kind of somewhere near record free cash flow. Balance sheets are all very strong, especially in the kind of, we especially think we can kind of find value in that small mid-cap space. So some of the larger miners are looking a bit more rich. Some of the big kind of blue chip names are kind of getting up to 1.5 times NAV, but we can regularly find names at kind of 0.5 NAV, 30% type free cash flows, which is a complete disparity versus wider, broader markets. So as a sector overall, there's a real trend now towards more dividends, more buybacks. We think there's going to be we've already started to see it, there's going to be a big uptick in M&A. We've seen a number of our larger names already taken out just by our focus on that portion of the market and attractive valuations that they've ended up being M&A targets, which obviously helps on valuation uptick. But I think you can kind of see why we have quite a lot of conviction around gold. We think it provides protection, and that's the reason why we currently around 50% of the fund weighted towards precious metal miners, which is the largest we've ever been. So now I'm going to try and tackle energy. So power and energy. So after years of being sort of villainized, really being put in the crosshairs of the kind of ESG target of any, kind of carbon emissions, etc., we've seen a real transition over the last 12 months around the views and perception of energy. And one of the things front and center to that is AI data centers. So big tech companies, where the battle has all been around chips. Everyone's been focused on NVIDIA, how you teach your language model, how that you get that to a stage where it is better than the next, ChatGPT versus Grok, etc. We're transitioning more to a point now where it's actually going to become about compute power, and compute power is energy. And this is hugely geopolitically important. Currently, estimates that I saw this week from McKinsey were saying US power, currently 5% of that is going to data centers. By 2030, that'll be 10%. Now, that doesn't seem like huge dramatic numbers, but this is a system that, these are energy systems, or the West in general has energy systems that are creaking under, having networks that were built 20, 30, 40, 50 years ago. So they're simply not in a place to be able to kind of grow capacity. So we're quite focused on where are the opportunities within that? How do we want to invest? Whilst the West has been heavily focused on renewables, and we have got to a point now where we're sort of globally, we're at around 30% renewables. I would be clear, 50% of that is hydro. So the issue here is that renewables provide variable power, and that is not suited to the requirements that we see we need for data centers. So it's geopolitically significant. AI is definitely a focus, both economic and militarily. We see that as a real focus. There's a real concern by the West that if China were to get ahead with its AI technology, that would become a military issue as well. And that's one of the reasons why we've seen heavy restrictions on chips going from the US and the West to China. So very geopolitically driven, but ultimately trying to solve an energy situation is really long lead time. We've got huge, like hundreds of billions of capex being spent by big tech on data centers, and there is no easy solution for where this power is ultimately going to come from. So we've seen some of the low-hanging fruit being resolved. So we've seen, and we'll touch on it around why we think nuclear is an important part of the solution. But we've seen some of the big tech companies funding restarts of nuclear reactors because it provides stable baseload power. But yeah, ultimately China has already won this race. The US is in catch-up, and the EU is still in denial. And when I say that, it's because China's built a very broad, widespread, ultra-high voltage grid network. It's been investing rapidly. It's been building 10 nuclear reactors per year. Just in the last month or two, we've seen them sanctioning the largest hydro dam ever built. So Three Gorges was by far and away the largest. And this new one they just sanctioned is 3 times as large, with the equivalent of 70 nuclear reactors in output. And again, that is like large, stable baseload power capacity that has. So they're already way ahead. The US is kind of scrambling to try and solve what it can. It has a network issue which can't be resolved within the next 5 years at least, if not decades. So really, you end up in having a very localized data center build out, and that's going to be predominantly around where we have energy. So what the US does have is gas, and it's been very successful with shale. So we're big believers that that shale is going to be the key part of the short-term solution because it is available. It's relatively easy to build gas turbines, and that's going to be important in providing baseload power into the data center build out. So that's certainly a theme that we're playing. And then ultimately we think uranium and nuclear really is like the longer term winning solution. So so I touched on it with China. So the top chart is showing reactor build out. So you can see the green is showing operating. So the US is still the largest market, with Europe sort of moderately behind. But China is currently building 10 reactors per year. So the West is more about reactor life extension, and the growth has been primarily driven by the Chinese build out. This is a multi-decade theme, which is one of the reasons why we own 11% of the fund is exposed to that. We obviously have a high level of expertise from running Geiger Counter, which is the world's longest running uranium mining focused fund. It's fairly niche, so that there's not a lot of competitors, but more so now. But the story's really shifted, and I think AI focused on data centers is one of the key drivers for that, and big tech coming in. And we've, on the right, I've put a list there of just a few of the biggest names that have really been focusing on nuclear as a solution. We've got Meta, Facebook, Microsoft, Google. Basically all the biggest names have been initially trying to take the restarts, also investing in SMRs. So SMRs are small modular reactors. We think they're very exciting for the West. Key reasons for that being, firstly, they're smaller, more modularized. So they are quicker, easier to build, and this isn't really a cost of energy issue at this point. If it's kind of cost 10% more or so versus the larger plant, it's about speed of actually getting access to that energy. So we think that's going to be a real driver at the back end of this decade. And then just in the last couple of days, we've seen the US really putting money into trying to accelerate SMRs through the likes of Oklo and NuScale with giving funding. And we're seeing the Department of Energy and the Department of Defense in the US really putting money into this. The Energy Secretary, Chris Wright, he's also on the board of one of the so he deeply understands that. I've met him before, and I know he's a massive proponent of nuclear as part of the solution. He actually made his hundreds of millions. I know he's not a billionaire, but he made his hundreds of millions from setting up a fracking company. So he deeply understands gas, and his belief, shared with mine, is that gas is part of the near-term solution with battery storage, with nuclear to ultimately come and fill in at a later date. So yeah, nuclear also provides energy security benefit. It's zero carbon, baseload power, which isn't something that renewables are great, but to get to a loading of renewables above 20% really in a grid, maybe 25%, you need to have a really large amount of battery banks. and we simply haven't seen technology get to that level at this stage. So what does this mean? Well, we've got a rapid build out. We've got reactors coming back that are assumed to be getting retired, and this is going to lead to more uranium demand. But uranium mining is very long lead, and this is where we're focused. We focus on the uranium miners. We actually focus on development assets because firstly, they're not spot linked. They are more linked to like the actual price rather than future contracts. So if you look to the likes of Cameco, they have a large amount of their future sales contracted at lower prices. And given the constructive outlook for the market, we see more upside in having greater linkage. And with the amount of money now flowing into the space, we think it's going to be a very attractive sector. So without going into sort of too much detail, but it was a fascinating space before data centers came along. Ultimately, the largest producer, Kazakhstan, larger than OPEC is in oil, they're struggling to increase production. We've had a coup in Niger, which supplied much of Europe's material, particularly into France. They are no longer supplying that material. So there was a real structural shortage. And then China and Russia also control the bulk of the fuel supply chain. So both enrichment and conversion and fuel fabrication. So it's really geopolitical. It's 20% of US power currently. They're looking to expand that. It's 20% in Europe, obviously about 75, 80% in France. So hugely geopolitical, hugely relevant. And clearly there's growing momentum for that. Another reason we really like it is that uranium itself is a very low proportion of the overall cost of power. So it's only around sort of 6-7% of the power cost now. So we need a higher incentive price to build new projects because it's simply not high enough. So we see a lot of upside. So uranium could double, could triple, could quadruple, and no one's going to use less of it. So we think there's a very attractive outlook, a geopolitical backdrop to it, which makes it quite technical. China's been stockpiling material. The West is short. They've only got 2 years of inventory, which is around the lowest it's been for decades. So we've focused within the fund on generally on Western-focused producers with assets that come online because we see more upside to them into that future contracting cycle. Okay, I won't dwell on oil for too long, but it always needs a mention. Ultimately, oil is slightly less strategically relevant than it has been historically. So one big component to that is the US is largely energy independent now with its domestic production, but also China has reached peak oil demand. The success of BYD and EV sales in China, we may not see it to the same extent in Europe, but in China, the rollout is huge, and we've likely seen peak oil. We will continue to see global growth, primarily driven by emerging markets, because their grids aren't up to sufficient scale, so it'll probably be more of a hybrid market where you'll still have oil and batteries. But the reason I bring it up, and I think it still needs a degree of discussion, is it's very geopolitically driven by sanctions. So the US not being reliant on oil to the same extent from the Middle East gives them free rein to apply tariffs and sanctions at will, or to a greater will. Now, Donald Trump clearly wants oil prices lower, and he talks about that regularly. But yes, I think we're in a position now where, just today we had the E3, so France, UK, Germany, threatening to put more sanctions back on Iran because Iran isn't allowing nuclear inspectors to come and check on their nuclear weapon development because there's no other region you'd be enriching uranium to the grade they were taking it. So there's a real heightened risk of sanctions and tariffs coming in there. So we could have a supply shock and real risk of sanctions on Russia with the Russian invasion of Ukraine. Trump's openly threatened that, and we're just days away from his latest 10-year timeline being put in place. So there is potential for a supply shock. There is not much spare slack in the system because OPEC's been increasing production. They've been allowed to increase their quotas, and there's very little spare capacity left. So we are not overweight. We prefer gas. A bit cautious on oil, but there's definitely some uncertainty there if we see a supply shock. And And then I'll just stay on this slide. So, I mean, we talked about our positioning. So on the bottom, it breaks out energy in brown, orange is precious metals, and base metals in a sort of greeny yellow, and then other. But that shows that kind of flexible mandate we take. You can see that post-COVID, we materially increased our energy weighting. That's because valuations were depressed. Those stocks rallied. We have lessened those now because we've got caution. Within that sort of 30% or so, that includes 11% in uranium and some exposure to shipping. So it's one of our smallest pure oil and gas kind of weightings we've had, with a preference for gas. Precious metals, we talked about our conviction there. Attractive valuations, like the top down, we think it provides good protection. And base metals, we're one of the lowest weightings we've been, although we are slightly turning our view on that. But again, that's a bit cautious around geopolitical fallout and the economic implications that could come from that. But ultimately, it also comes back to Chinese property sector. So the Chinese property sector has seen a crisis, real property crisis for the last 3 or 4 years. And a number of people talk about it like a V-shaped recovery. We just don't see that. We think demographically that just can't happen. And this is an issue globally, but very acute in China post one-child policy, where simply demographics mean the population's in decline. So when you've got excess property and a population now in decline, you're not going to see a sharp recovery in a construction sector, because you're going to have an excess of property with declining populations, unless you have massive immigration. So that's more extreme in China than elsewhere, but it is a bit of a global issue, which also ties back into to that broader debt issue. You can't have ever increasing debt and shrinking populations at the same time. That's really that really draws the pressure. And I'll probably leave the last slide because I'm time pressured, which was kind of summarised there.
Thank you, Robert. Any questions for Robert?
Yeah, private investor, long term, haven't bought a unit trust for many, many years. It's all ETFs and investment trusts now. Thank you. My question is about something you mentioned, battery storage, and by implication, the importance of that. Yeah. Can you say anything about key materials and technologies for enhancing battery storage? Because clearly that is an issue regarding solar and wind, particularly.
And I could spend a long time on this, so I'll try and be brief. So lithium-ion batteries were effectively invented because they're light and easy to transport. So they're good for cars, good for your phone, but actually, they're slightly inefficient on grid storage. And grid storage is one of the real key issues actually going forward. We've done quite a bit of work on it, and we'd looked at sort of vanadium redox batteries, zinc redox batteries, and actually I think what it's looking like, the way battery technology is moving in China, I think it's going to be sodium-ion batteries, which are effectively much cheaper because you don't have the same expensive inputs going in. And I think we're a couple of years for that to start to get rolled out more materially. So that could become a bit of a grid storage issue. Solar I think is better because it's far more predictable, because you kind of know it's it's going to be light in the day and dark at the night. So it's much easier. You don't have to cover yourself for such peaks and troughs or long periods. That's a real kind of fundamental issue for wind, where you can have Dunkelflaut, where you can have middle of winter, you can have no wind for 20 days. But yeah, so sodium-ion batteries, I think, are the thing that will be the game changer of that in a few years.
Why invest in your fund compared with royalties?
Firstly, we aim to outperform them. I mean, we can own royalties as well, and we've held wheat and precious metals in the past. We thought that was attractive. Royalties are, they're good. They're a good way of generalists getting exposure without taking quite the same level of specific asset risk, particularly for some of the bigger ones. So I'd never discourage people from looking at them. It's our belief that we we will outperform them because we can get that exposure, especially given the point of cycle that we're in. Royalties predominantly are dominated by precious metals, so I guess that's more specifically where we're talking. But yeah, I mean, ultimately it's a relative call. We can own them. We choose not to, or not have a material exposure. We have a little bit of wheat and precious, as I said, because we see better value opportunities in the others. And also the point in the cycle, I think we're really coming into, on the precious side specifically, really coming into that kind of M&A catch-up cycle, generalists kind of catching up to the theme, and kind of gaining more exposure as balance sheets continue to improve.
Thank you. A couple of questions on medium to long-term outlook for demand for specific commodities. Thinking first of all of oil, there for a while been two completely opposing views on the outlook for oil demand. There's loosely known as peak oil theory, so suggesting that geological constraints will cause production to decline more quickly than demand, obviously resulting in price spikes. And then at the opposite end of the spectrum, you've got the stranded assets theory, where cheap and abundant renewables will displace oil as an energy source, and we'll end up abandoning even the oil fields we've found, which will become worthless and the price of oil companies will collapse. So I'm just curious to know where your view of the medium to long-term outlook for oil rests between those two extremes. And secondly, demand for uranium and potential increase in nuclear-generated electricity. Do you see any risk from future reactors being powered from plutonium extracted from reprocessed fuel and therefore impacting on demand for uranium in the medium to long term? Thanks.
Okay, so I might tackle the last one first. On reprocessing used material, there's a couple of companies doing laser enrichment, so the likes of Silex, which is probably leading currently. They've just got, they're in discussion for potential US funding to reprocess some tails in the US. So yes, there is an aspect to that. It's not, we don't have any details on costs at this stage. I think the belief is that it'll be relatively high cost. So sort of more around current prices now or higher to produce. It would be done at the margin because it's not going to displace completely. So there is an aspect to that, but it's not enough to kind of really change the thesis. If anything, what it does is more complete the circle on the whole fuel chain. On the oil versus assets, I think those two extremes are, I mean, unsurprisingly, I disagree with both and sit somewhere in the middle. But I think the reality is oil is such high density energy that you can't really displace it. And we talked about kind of emerging market growth for demand, and that's the primary driver of new demand or demand growth. And they simply don't have the grid network. So there's still going to be a major component of oil in that. You know, even the IEA, who are very kind of left-leaning and pro-renewable, still kind of see positive demand growth, albeit at a low level. So we're not talking multiple million barrels per day from the current around 100 million barrels. It's more like 500,000 or kind of in that range. So kind of view it slightly flattish. I do think China rolling out EVs as successfully as they have has sort of changed the equation slightly because they're coming in just so much cheaper. You can buy EVs for $10,000 now basically in China. So that really does change the dynamic towards accessibility in emerging markets. But I think ultimately grid networks negate that. I think they stop that rolling out and we go for more of a hybrid market. So I think oil demand remains. Renewables, I mean, we see these great stats about how cheap they are. If they're that cheap, why does everyone get so upset when subsidies get pulled and then suddenly rollout collapses because they're not getting subsidized? The reality is they are cheap at the point that they're producing. They're not cheap if you then have to provide the storage and linkage, because often the expensive parts is linking far offshore, bringing it in, and then having to store. So to get something comparable to more conventional power, actually, once you do all of that, then it isn't as competitive. And in some cases it is, in some cases it isn't. But if it was cheaper, then market dynamics in its own right would see that investment increase without having to need subsidies. Did that answer all the questions? I tried to square it up, but
Hi. Two kind of different related questions. The first is in terms of oil. Is it underrated as an actual industrial input commodity? I'm thinking things like the plastics industry and that sort of thing. And also in terms of gold, this is going to be a bit of a left field question here. What is, because I agree with you with like in terms of the US debt and that sort of thing, but looking back through kind of US history in the 20th century, is there at all any risk of potential gold confiscation like we saw under FDR in the 30s?
That's a definite left field one, and I'm not sure if I can add anything much more on that. But so firstly on plastic, so reality is plastics will continue to grow. A lot of that is coming from propane, which gets turned into propylene, and we actually do play that through within the fund. So we have a position in a company called BW which is the largest propane shipper. Propane is produced as a byproduct from US shale. It's not burnt in the US and then exported from the US to China, where it goes into PDH plants and then turned into plastic. So is industrial applications, I mean, actually, I think generally it's fairly high value, so it's mostly refined and turned into end fuel for propulsion, cars, planes, etc. So I think that continues. I mean, we have seen oil burnt for energy in the Middle East, but they've generally worked out that that's terrible economics and phased that out. On gold being confiscated, well, yeah, I think unlikely. I think very unlikely. I think that's pretty extreme that we get kind of a shift like that. But I mean, you have to be in a pretty dark position. That certainly wouldn't be my base case. I know there's always scope for these things to happen. I mean, I think what is kind of interesting, and when I was kind of just refreshing on the numbers here, I thought it was kind of interesting to see that the ETFs are 300 billion in size, and then bar and coin is including bar and coin, it's 3 trillion. In assets, so almost 10x the size is bar and coin. So it does sort of tell you that maybe people there is a degree from ultra high net worths or those that own bar and coin to kind of seek that protection outside of the financial system. So there's certainly an aspect to that where people are concerned around the caution. But yes, I'm not sure I can add any more. any more.
Thanks very much, Peter. Robert. I'm sorry, we're going to have to cut short. We've run out of time, and I don't want you to miss the next set of sessions. But you've got about 5 minutes for a room change. So thank you very much, Robert, for your presentation and answers to the questions. You've got 5 minutes as well to catch Robert before you switch over if you've still got questions to ask him. So thank you.